Hello everyone, welcome back to another podcast of the OP Club. We have today a special guest, Christopher Wein. He is the COO of Equiton Developments. He has over 25 years of development experience in the real estate world, and he brings with him an expertise today to talk about more of the market, as well as the development side of things, what's going on. So we'd like to welcome the special guest on our show, Chris.
Thank you so much, Chris,
you
for coming.
Welcome.
Yes, I appreciate it. Thanks for having me.
It's going to be an easy episode considering you're very well spoken.
Okay, thank you.
You're just on BNN actually.
I was.
We were talking about it
Yes.
last
2 weeks ago. Yes, exactly.
You just joined Equiton Developments.
Yes.
You're with some of the biggest developers in the GTA, like Lantera, like Great Golf.
Yes.
You've worked all across North America.
Correct.
Can you tell us a little bit more about your role?
Sure. So Equiton, what excites me about Equiton Developments is Equiton's been around for 10 years as basically a private equity real estate company. They have raised and have assets under management of over almost $2 billion. And they really wanted to create a development company for the future. I see the market changing quite a bit, and I thought that this was a great opportunity to be able to build a development company to operate within the GTA, but that would really look at what's going to happen with condos and housing as we move into the next 10 and 20 years. I think the past 20 years has been a great boom for the condo market, but I do think it's changing, and I think it's exciting to be able to be with a group that's looking for rapid growth and really looking to innovate within the industry.
Because it is an interesting time to get into the pre-construction space. Yes. As we all know, it's a challenging time. So how do you think Equiton will, because they have experience with the...
Yes.
Yeah, so what's interesting is for the first 10 years of the company, they focused on income-producing properties, so buying existing apartment buildings and commercial buildings all across Canada. And they built up a significant portfolio and have a significant investor base. So now as we move into development, really what we need to look at is what does development in the GTA look like going forward over the next 10 and 20 years, and how is it going to change from what happened before? And I think one of the bigger changes is people are going to look to more boutique style buildings. I think we're going to see a lot more sort of mid to high rise buildings going up. And I think that neighborhood, being in areas that are existing traditional neighborhoods in Toronto is really, really important. So, for about a 20-year span, the high rise built form dominated the Toronto skyline, and we developed literally tens of thousands of units in these 50, 60, 70, 80-story buildings, and I did a lot of those buildings. And I think that product is now saturated. And I think now what we're going to start to see is we're going to see the traditional neighborhoods, places like the Annex, places like the Junction, Leslieville, Trinity Bellwoods, etc., Yonge and Lawrence, neighborhoods where people have always wanted to live and primarily lived in low density, so lived in single-family homes and townhomes and row housing and so on. That's becoming unaffordable. So what's going to replace that is you're going to have 10-story buildings, 15-story buildings, 25-story buildings. They're going to be more boutique, more designed around end users and livability. And I think that if you can keep your unit count below 300, that's very, very different than the living experience in a building with 900 units or 1,100 units or 1,200 units, which is really what the mega towers deliver. So that's where I think that's where Equiton's focused. The land is that we have 7 development sites ready to go, and they're all in great neighborhoods.
That is kind of interesting to focus on because affordability-wise, it's certainly not the most affordable market that we have here. I think Canada, like real estate has been such a favorite investment vehicle for a lot of people that I think maybe a lot of speculation has gone into it that has driven up the prices, especially in the condo market, like pre-construction. But we've obviously seen a slowdown in the sales of pre-construction, so there's going to be less supply in the market now, right?
Correct.
Where are the prices going? Are we going to see more of a dip in prices? Because I don't think the people who bought in the last 2 years would like to see a price decrease, even though affordability is important and obviously housing is a necessity for everyone.
Yeah, I think what's going to happen is from a pricing perspective, if you look at Toronto real estate over the last 25 years, It's generally a relatively steady elevator ride up. Now we do have our moments where we have recessions and so on, like the financial crisis in 2008, 2009. We've had other recessionary pressures right around the beginning of COVID, which then ended up being super inflationary. Now we're in a recession as we speak today. So Toronto will have these little dips, but if you look at it over a 25-year period, it goes up, up, up. It dips a little bit, goes up, 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 dips a little bit, but it consistently goes up. So the secret to real estate investment in Toronto is to make sure that you have the sort of holding power. So I think where some speculators got hurt right now is that there is product that they may be closing on today that they would struggle to either finance at the value that they bought it for, or to find tenants that can subsidize the rent enough to support financing based on that value. But that's a very temporary situation. And again, I never kind of encourage speculation. I look at real estate investment, or I look at real estate purchases in Toronto. We basically have three markets. So we have an end user market, so people who are actually buying the product to live in. We have a true investor market, and an investor really is someone who looks for long-term value. So people who are buying condos and townhouses that they're going to hold for 10 years, 15 years, 20 years, and they're going to get a great equity gain, and they're going to rent them out, and that rent is going to help either fully subsidize the carrying costs or mostly subsidize the carrying costs. But the equity appreciation overwrites that, so it works out great. And then the third market is the speculative market, which is I'm going to buy pre-construction today, I'm going to wait 5 years, and when it closes, hopefully I've made enough that I can flip out of it and make some money off the deposit funds that I put in and do an assignment or flip right after closing. That market is been pretty damaged of late, and I think that market is not a market that is going to rush back in. And I think that's why you're seeing such slow sales right now. And I think that's where, as the development community, we really have to look at, okay, if we take speculators out of the mix completely, what are the products that long-term value-based investors want and that end users want? And that's where I'm suggesting that it is going to be smaller scale, more boutique buildings that are in better neighborhoods, that are better built with basically better design and better overall livability. Because if I'm an investor and I buy a building that will retain its value because it is a great building, and you see some of them like there's 80 and 100 Yorkville that were built probably 10, 15 years ago, they still hold their value fantastically because they're boutique buildings. They're in an amazing neighborhood. They were extremely well built. And units there rent out immediately whenever they become available, and they sell immediately whenever they come available. So, the thesis works. The challenge is that, the tens of thousands of units that we built in areas like South Core. South Core is not a neighborhood. South Core is next to the Gardiner Expressway, sandwiched between literally the Gardiner and the Lakeshore, and has the ACC, or the Scotiabank Arena, and the Rogers Centre. Nobody, grows up thinking I want to live next door to the Rogers Centre. So that's not a neighborhood. But if you go back to places like the Annex, the Junction, Leslieville, those are areas that people have always wanted to live in, the Danforth. And there's a ton of density left in this city. It's just, we have to unlock the density through different build forms and not necessarily giant towers.
I want to ask a question because I'm sure some people would think that, is it like if the building is boutique, like let's say it's 15 stories rather than 50 stories, does that mean like the prices will be higher or not necessarily?
Not necessarily. So one of the other things that's happening, so the interest rates don't just hurt the end user or the buyers, I should say. They also hurt the developer because we borrow more money than anybody. So as developers, the construction financing is the biggest part of our cost structure. So when interest rates are high, our costs are much higher than normal.
And it's all variable rate, right?
Correct. So to build a 50-story tower literally takes between 4 and 4.5 years from when you first put the shovel in to when you're actually closing the building. So the challenge with that is you're borrowing hundreds of millions of dollars for 4.5 years. And if high interest rates, that can really hammer you. With a more boutique building, a 15-story building, you can build in 2 years. So now your risk, your interest rate risk is actually much less because in a 2-year period, generally speaking, you should be able to predict where the rates are when you begin the project and where you think the rates are when you end the project. But in a 4, 5, 6 year cycle, you have no idea where the rates are going. So you take on incredible risk, and that those costs do get ultimately passed on to the consumer. So even though there's an argument that boutique buildings cost more from a constructability perspective because you don't get the economies of scale, when you factor in all the other the timing issue, the interest rates, the zoning battles, etc., it's all a wash. The boutique buildings, actually, you can build faster and more efficiently than you can the giant buildings.
With a 2-year construction timeline as well, people aren't going to be speculating as much. It's more
Correct.
so they're thinking of moving into it, and they're thinking about today's market. Also, if it's boutique, then they're likely going to stay in the place longer as well.
Correct.
Just because, like, as an investor as well, if you buy into it, obviously most of these buildings are not cash flow positive or, like you said, subsidizing their cost of ownership. So, like, moving forward, are you going to see that it is going to be more end user focused?
I think it's going to be a combination. I think if you look at the value-based investor that's there for the long term, what they're looking for is the exact same thing the end user's looking for, because an end user's looking for a building that is going to be highly livable, a building that's going to continue to appreciate, because no end user wants to make an investment. You don't want to buy a house that goes down in value. And when you think about the housing market, that's what everybody, that's the thesis is, I'm going to buy a house and I'm going to pay the mortgage over 10 or 15 years, and I'm going to create a whole bunch of equity, and then eventually I might sell that house and move to a bigger house. Well, the condo market's no different. The difference is that the end users aren't really buying 300 and 400 square foot units and 450 square foot units. Those were speculators buying those units, thinking that, hey, as long as the market continues to grow, I'll be able to unload those units. And what's happened now is that as people see the livability of those units, it's not there. And so it's very hard to either find tenants, or it's difficult to actually sell those units. So if you go back to a boutique building where, you build proper sized 1 bedrooms, 2 bedrooms, 3 bedrooms, and you look at it that as an end user, I'm going to buy that in that building because it's in a great neighborhood and it's a well-built building that isn't too big, so there's not a ton of competition within the building itself, then I should see long-term gain over, say, a 10-year period. Now turn your face to a value-based investor. Same thing. They want to buy in a building where there's not too many units, where they're not going to have internal competition, where they can get a unit that will command high rent, and where they'll attract tenants that are actually tenants that aren't necessarily, 6-month tenants or 9-month tenants, but that they're families or established neighborhood people, or even empty nesters that plan on living in that unit for 3, 4, 5, 6, 7 years. And what's going to happen is the same thing. Even if they have to slightly subsidize, the equity appreciation over time will counteract that. To have a quick example, so even during COVID, and we know in COVID that, at the beginning of COVID, there was a challenge with existing tenants and existing units. So my wife had a unit at Bathurst and King. So 650 Bathurst, or 650 King. It's a great building, boutique, so
Busy
on.
neighborhood.
Yeah, great neighborhood. Everything's great. So she had a tenant, lost the tenant, of course, because COVID, everybody disappeared. So she had to take on a new tenant. Rents were low. So she went from $2,600 a month in rent for a 1 bedroom to $2,000. No problem. So then we had it rented for $2,000 for a year. Now we get into 2021. She's like, you know what? I'm subsidizing this because at my mortgage and taxes are $2,600. So now I'm losing $600 a month. And she's like, let's just sell it. And I said, okay, well, let's look at what it's going to sell for. So the market was difficult at that time. So the broker said, it's probably I could probably get you 615, 620. Because it's a good building and so on. And I'm like, that's giving it away. So I said, let's just keep the tenant. We'll pay the $600 a month. So we waited a year. So $600 a month is basically $7,200. So it cost my wife $7,200 to subsidize that unit for another year. Then she put it on the market. She put it on the market for $689,000, and she ended up selling it for $695,000. So by subsidizing $7,200 and waiting for the market to come back, she ended up making an extra $75,000. So but again, good building, good neighborhood, not too many units, well-designed unit, etc.
For a value investor, when they buy into a great project and a good neighborhood, even then, I know that when they look at today's rent prices, especially when it's a little bit softened right now, it's not going to cover what their cost of ownership is going to be like. But through the future, like, do they kind of have to eat that cost up and then just think about the overall long-term growth of the unit?
You have to choose the right building, the right builder, the right buildings, and the right neighborhoods. For instance, like if you think of the annex, like properties in the annex don't go down in price. The annex is such a highly sought after neighborhood. So really, and the part of the annex I'm talking about is really everything between Bloor Street and DuPont, and from Avenue Road to, say, Bathurst, like that pocket, whether it's condo, townhouse, row house, single family house, that pocket people want to be in, people have always wanted to be in, and the values either hold or go up. So if you look at Toronto real estate and you say, okay, over the long-term period, Toronto real estate increases, on average, prices go up between 5 and 7% a year. So if I hold a property for 10 years, then in a 10-year period, if I'm in the right neighborhood, in a good project, I should see the price of my unit go up by at least 50%, if not 75% of what I paid for it. So then if you go back to the subsidy rule, so if I pay $900,000 and I wait 10 years and it's going to be worth $1.5 million, and I had to subsidize that unit $10,000 a year, well, I only subsidized $100,000 and I made $600,000 return. So again, you're not really like, yes, it may not carry itself today, but ultimately it will. And then with respect to rents, right now we're in a time when we had unprecedented sales activity from pre-construction sales activity from 2019 to sort of early 2023. And we sold more pre-construction condos than ever in history. And we built those condos. And now, as of sort of the end of 2023, throughout 2024 and into early 2025, we're now delivering all those condos. So we're delivering literally 50, 60, 70, 80,000 units a year. So we've oversaturated the market. And then at the same time, because of interest rates and affordability, people have either decided not to make a move within the Toronto market, or they're sitting and waiting for better times, or they're bunking up with friends and family. But we don't have enough tenants for the amount of deliveries that are coming out. And then what ends up happening is we have speculators who ultimately will become desperate and will take any rent. So they're driving rents down temporarily because they're just like, hey, just fill the unit. I know it should be renting at $2,500. I'll take $2,000. Nobody wants to rent it for $2,000. I'll take $1,800. But this is a temporary situation because although we had these great sales and we had all this delivery, now the opposite is occurring. So very little sales in 2023. 2024 has been non-existent. 2025 will be tough again. And maybe 2026 will start coming. And what we have to remember about pre-construction is the sales come 3 to 5 years before the product. So we're going to have this gap that there's going to be no product available, no new product coming to market being finished in 2026, 2027, 2028. We're probably not going to see new product till 2029, 2030. The Toronto market needs 30,000 units a year just to fulfill the housing demands and the growth demands. So right now we're in this funky place where we have too much supply and not enough customer. And in a year and a half, we're going to be in the exact opposite place where we're going to have too many tenants and no new supply. And unfortunately, we can't turn new supply on overnight because it takes 5 years to build in many cases. The other thing that's going to happen is that the demand for unit types is going to change. So the demands we're already seeing, like 2 bedrooms are in high demand on the rental market. Larger 1-bedroom dens with 1.5 or 2 baths are in high demand. What's not in demand is small 1 bedrooms, 2 bedrooms with 1 bath, and studios. Studios are in no demand. So the other thing that's going to change is that some of the buildings that are already built that have sort of the wrong unit mix, those buildings will struggle and may struggle forever. But that's not going to affect the new buildings. So new buildings will build better product that's more suited to the future demands of the market, and that will supersede. It'll hold its value. You'll be able to get better pricing up front. You'll get longer term value. You get better tenants. You'll get better rents. And there'll be some buildings that just get stuck in the past. I was never a fan of studios,
especially when they're 300 square feet.
Exactly. When I was with Great Gulf, we never did a project that I would like under my time in leadership that had a studio at all. We always talked about it. We're not doing studios. Like they don't make sense.
Even in Toronto.
Even in Toronto, we never did studios.
Because if you look at other major cities, New York, Tokyo, they all have these sizes, right? So you think that Toronto is also going that direction, but
it's not, because the challenge with Toronto. So one of the things is we need to be careful when we compare Toronto to major international cities, because it's not really the case. We're not. We are a great city, and we're Canada's largest city, but we're not an international sort of tourist destination by any means. Like our tourism in Toronto is probably 1/30th of what New York is and Manhattan is. It's crazy. And we're not London, we're not Paris, and we also grew up differently. And whether we're second generation Canadians, or whether we're first generation, or whether we're new immigrants, you come to Canada for the space. You come to Canada because you don't want to live in a 300 square foot shoebox. And in markets like Hong Kong and like Paris and like London and like Manhattan, those markets, because of affordability, had to, that's just, the way of the world. But the cities are also designed differently. I spent a lot of time in Asia, and many, like in China, many buildings, in your unit, you don't have a kitchen. In many cases, you have shared bathroom facilities and so on. It's just a different way of life. Like you can't go to Shanghai with 30 million people and then say, well, Toronto has 7 million people. It's going to be like Shanghai. It's nothing like Shanghai. It's never going to be like Shanghai. It's just different. So what you really should look at is you should look at cities in the U.S. like Dallas, Miami, Houston, Washington D.C., Chicago. They never went that direction. Like even L.A. and San Francisco, they don't have tiny units. Like New York is a bit of an anomaly, and even today in New York, they really don't build a lot of tiny units.
Economically, it's so different too, because so many Canadians we kind of head towards real estate because it takes like a huge part of our GDP and the economy. Like US, like they're more business focused, and they haven't run up the prices as much as it has in the GTA.
Correct. Well, the other thing about the US too is like one of the things that is confusing when you look at the comparisons between the GTA and any US city is the GTA represents 25% of Canada's population. So there's 40 million people in Canada, 10 million live in the GTA. Which is crazy. So if you did the same comparison to the U.S., New York has a population of about 18 million, the greater New York area. And if it was the same as Toronto, New York would have a population of 90 million. Because if 25% of the U.S. population lived in New York, it'd have to be 90 million people. So that's part of the challenge with the pricing. Is one of the things that happens in the U.S. is the U.S. population is much more mobile. And we see that, and they're willing to move all over the place. So you see where literally hundreds of thousands of people that used to live in New York will now move to Florida, and hundreds of thousands of people that used to live in California have now moved to Texas. And a lot of it's for jobs and taxes and so on. And even massive employers make these giant moves. In Canada, it doesn't happen. Toronto is the economic engine of Canada. It's the manufacturing capital of Canada. It's the tech capital of Canada. So you have every major industry and every sort of major economic activity occurs within the GTA. So it's challenging because it's not so easy to say, well, I'm going to move to Saskatchewan. Well, what are you going to do in Saskatchewan? How are you going to find jobs? I love Saskatchewan. I built in Saskatchewan, but it's not, we don't have a Dallas. We don't have, a Denver. We don't have a Washington, D.C. There's, even relocating from Toronto to Calgary. Calgary, I lived there for years. It's a great city. I developed a lot of buildings in Calgary, but it's not Toronto. It's 1/10 of what Toronto is. Whereas, Dallas and Houston are cities of 6 and 7 million people. Chicago's a city of 7 million people. Miami, 5 million people. Washington, D.C., 5 million people. L.A., 13 million people. So there are huge opportunities across there's 50 cities in the U.S. that all of us could live in and thrive in. And in Canada, there's 3.
We've seen an increased number of people actually moving to Calgary, but do you see that trend continuing because of affordability or?
Yes and no. So I've seen the trend before. So, that was a big trend. Like Calgary had a big run up before the financial meltdown. So Calgary between 2001 and 2008 was on fire because everybody was moving to Calgary. It was the Alberta advantage. You had no sales tax. You had oil and gas going crazy. You had less income tax. So it was just fantastic. And then it crashed. And when Western Canada crashes, it really crashes. So we have to keep that in mind too. Like this GTA crash that everybody's talking about, we're still talking about, like 10%. Like we're literally suggesting that, hey, you might have bought something if you had really terrible timing. You might have bought something for $900,000 that's maybe worth $850,000. What I can tell you is there's buildings and units that I built in Calgary in 2009 and 2010 before I relocated back to Toronto that I can buy today for the same price that I sold it for in 2009. So in 2024, I can go to a building that was built in 2009 and 2010, and there's been zero appreciation because when some of those other markets go up, they can be pretty good on the way up, but when they go down, they can see 30 and 35% drops. You're never going to see that in the GTA. The GTA is never going to have a 35% drop because, again, the growth, 75% of all immigration that comes into Canada resides in the GTA and settles in the GTA, and that's really what's driving it. So the few people who leave are being eclipsed by literally the thousands that are coming every single day.
Going back to the construction side of things, a big part of the costs for developers is like development levies by the government.
Yes.
Why is it that the city charges so much to the developers?
That's the great mystery, and that is something that's very interesting because that is where some of the other markets in Canada, like Calgary, Edmonton, Saskatchewan, many places in BC, etc., are much more affordable from a taxes and levies perspective. So it is interesting that there are cities that you can. The development charges for a high-rise condo are $2,000 or $3,000 a unit, and then we have Toronto where it's $60,000, $70,000, $75,000 a unit. So there's I would say there's some confusion as to why those costs are so high, and I think that the politicians are starting to really look at it. I commend what Mayor Chow did recently with purpose-built rental, where they're going to waive the development charges. Which I think is fantastic, and have the tax abatement. So I think that's gonna spur definitely more rental housing, which is highly needed in the city. But we also want young people to be able to get into home ownership. So I do think that for first-time buyers, we really should look at some kind of development charge rebate or relief to a certain extent. Like maybe it's limited to $1 million or less, because we don't need to subsidize millionaires and billionaires, but I think regular working class people in Toronto need help, and I think that would go a long way. And it can be a rebate that's applied at closing. I think the other thing that would be really helpful, and certainly some of the politicians or some of the the person who wants to be prime minister next, Pierre Poilievre, has come out about 2 weeks ago and suggested that he would get rid of GST for for any purchases under $1 million. I think that the provinces would follow suit. So we have to remember here that it's HST. So GST is going to get us halfway there. But then if Doug Ford agrees and also would be willing to waive the provincial portion of that would be huge. That's a 10%, basically 10 to 11% decrease. And again, why are we taxing people that are trying to get ahead? because really you want your population, in order to have a really balanced and healthy housing market, you constantly want new buyers to be able to get into the market, because what the new buyers getting into the market does is it pushes the existing buyers into larger homes. And that's a good thing, because you should have a cycle. You want to have first-time buyers buying first-time homes, both in pre-construction from developers like us, but also buying resales. And then that pushes the next generation who already own to then buy bigger, more family-style units to raise teenagers and so on. And then that pushes into the seniors who then want to downsize, and seniors should be downsizing into condos. It's so much simpler. So then you get this really healthy cycle, because oftentimes you can have the seniors buying back into the first-time buyers' homes, as the first-time buyers are then moving up into the secondary and tertiary homes. So that's kind of what we want, and that's been working for 50 years. And I think just because of this mass speculation that occurred in the last sort of decade, things got a little off kilter, but they're going to go back. And same thing, if you're an empty nester and you're looking to downsize into a condo, you're not moving from Lawrence Park to South Core. You're not moving into a 50 or 60 story tower next to the ACC in a neighborhood you don't understand and have had nothing, no connection to ever. You're selling your house in Lawrence Park, and hopefully there's a beautiful project somewhere on Yonge Street or on Bayview or on Mount Pleasant. That again, and you're going to want something where, if you're coming from a single family house, you're having a 60, 100, 120 unit building, you're going to feel comfortable in. Moving into a 900 unit building with 7 elevators, 8 elevators is going to freak you out. So and you don't want to move from where your butcher shop is, and your fishmonger, and your cheese shop, and where you buy your dresses, and where the your local pub and your favorite restaurant and your grocery store,
your doctor,
exactly, your doctor, your dentist. And that's why, and what's interesting, because you could ask the question, well, Chris, why hasn't this happened earlier? And there's a couple things. One, the market, the development community got very focused on high rise, but real high rise, and they got very focused on being able to buy empty parking lots and things like that, and converting them into 50, 60, 70 story towers. And it was a good business, and there seemed to be lots of demand and so on, and sort of no one was paying attention. And at the same time, the city, when you went to neighborhoods, when you went to great places like Lawrence Park and such, and you said, "Hey, can I build a building?" They said, "Oh, no, this is too much. This is a neighborhood. This is residential. You can build a 4-story building. You can build a sixplex." Well, that no one's doing that. So what happened is the city was actually in many ways pushing the development community to build high rise in the core in places that traditionally didn't have a lot of housing, and where there was a lot of low density housing, they were saying, let's just keep it below density. Well, that's now got to change, and you're seeing it change. Recently in council, I think it was Brad Bradford that brought forward that on any of the major streets and avenues, which would be Yonge Street and Lawrence and Eglinton and so on, that they want to go to as-of-right zoning of 11 stories, so that you don't have to go through a huge multi-year kind of fight to build a 10 or 11-story building, which is what it used to be. And if you're going to have a 3-year fight to build a 10-story building, you might as well have a 3-year fight to build a 50-story building.
Yeah.
So
there was such a huge demand and short supply because of the population increase. But now that we're seeing that the government kind of wants to step back and say, hey, we're going to decrease the target number here.
Yeah, so that doesn't bother me that much, because I think that this has been over talked about. So again, if you look at the Toronto condo market, really started in the late 90s. So it really was 1997 when things got going, and it ran tremendously until, call it COVID, till 2020. So for almost 25 years, you had an extremely healthy market. Prices generally continued to rise, except for during big recessions like in 2008 and 9, but then they quickly rebounded. And we had a healthy sort of tension between supply and demand. So What drove that? What drove that is immigration numbers coming into Canada of 300 to 400,000, which has always been our case. So you had 300 to 400,000 immigrants coming in. It was a controlled immigration policy. You had to qualify. You had to have oftentimes sponsors for employment. You had to have some kind of accreditation or degree or profession. And it was very, very healthy. And again, out of the 300 to 400,000 every year, 75% of them came into the GTA, and that's what really grew and blossomed the GTA. So and everything was great. Then post COVID, because of the things that are happening around the world, which are awful. So wars in the Middle East, wars in Ukraine, humanitarian crises all over the world for all intents and purposes. We ended up with a massive amount of immigration for the last 2.5 years, almost 1 million people a year. But primarily it was because of the state of the world and huge amount of refugees, huge influx. The challenge with refugee influx, and my parents were refugees. I'm first generation Canadian. They came during the Hungarian Revolution. What happens with refugees is refugees generally don't come super well equipped. So they're not coming buying property. They're not coming necessarily with a lot of degrees and so on and so forth. They're coming because they're fleeing a terrible situation. And it's wonderful that Canada opened its arms to this. And often as a refugee, what happens is sometimes you're coming in and being, living with other family members, being billeted, and so on and so forth. So you're not actually increasing demand on housing, because what happens is, you have a house with 4 or 5 people living in it 2 years ago. Now there's a refugee crisis. These are relatives, so I bring in 3 or 4 to help the refugee situation. Now I have 8 people in my household. I didn't change my house. I didn't buy a bigger house. I didn't buy a second house. I just put more people into the existing infrastructure. And you really see that. You can see that in the city. You can see in places where the infrastructure seems under tremendous demand. And we're sort of overflowing at the seams. That's what's happened through that immigration. So that's not sustainable. So the fact that all levels of government and all political parties are saying, hey, we have to take this back to where it used to be at that sort of 400,000 range, that's actually going to be healthier. So the idea that, hey, if we actually pull back on immigration, it's going to kill the housing market, is like, no, if we pull back on immigration to what we traditionally were doing over the last 25 years, it's actually going to make the housing market more sustainable. And it's going to get us back to where we had very healthy markets. So I fully support going back to a more controlled immigration policy, because that's what drove such great growth the last 25 years. And it's the same it's like work from home. It's the same thing. Everybody decided there were going to be no offices ever again because of COVID, and you can't make decisions over short-term pandemics. Just like the world was very different during World War II. I wasn't there, you weren't there, but it sure wasn't like today. But however it was different, they didn't say that's what life's going to be like for the rest of time. It was like, okay, this is 5 years where everything's upside down, and we're going to come out of it, and then things will eventually revert.
I want to ask you a question. Since you said the future will be targeting long-time investors and also end users. So
yes.
One thing we struggled with the end users buying pre-construction is it's only a floor plan, right? So they can't see the unit. So do you think like builders will do something different? Are they going to maybe do 3D tour or something like that?
I think a couple of things are going to change. So I think, again, as a developer, time is your enemy. And I think that now that we're going to, enter into a more balanced market, developers will take advantage of being, sort of more diligent with time. And what I mean by that is they're going to make sure that they have their approvals in place before they launch sales. They're going to make sure that they have a building permit before they launch sales. If they have a building permit before they launch sales, or at least are able to obtain a building permit, they have all the drawings to that level, then they're able to price it properly. One of the biggest challenges that we have in this sort of frenzy of pre-construction is often you're selling a product that you don't really know how much it costs to build. And that's dangerous. And when prices are going up endlessly, you can sort of live with that danger. But when you get into any kind of recession, then that really becomes apparent. So, and I think this plays into my thesis of the smaller buildings. So if you're doing a 200 unit building that's 15 stories, it's a lot easier to get the drawings done. It's easier to get the approvals in place. You're going to understand what your costs are, and then you're going to launch it into market. And what's interesting is, depending on, kind of what your capital stack looks like, I think, like what we see in other markets around the US and North America, is most other markets, they don't launch sales until they've started building the building. So when you go to New York, for instance, in New York, you don't actually launch sales until you've topped off the building. So you actually finish the superstructure, and then you walk people through, with a hard hat, through the hoist and through the units. And at that point, same thing in Florida, you basically say, hey, this can be your unit. This is what your view looks like. Here's how we can finish it. And you buy it at that point. So, and what's interesting is you pay as you go in many cases. So in Florida, deposit structures are often up to 50%, but you're not paying 50% on a piece of paper. You're paying sort of 5%, and then as they go further, another 5, another 5, another 5. So you pay as you watch the building come together. Exactly, and based on cost structure, and that's very healthy. So I think you're going to see some developers and developers like Daniels already do this. In many cases, Daniels will build the building and then sell,
yes,
which is very clever. You just have to have deep pockets to do it. But if the buildings are getting smaller, I think some developers will have that opportunity. And then the other thing is, even with end users, I think we're going to go back to the idea of like full show suites. Yes, I think we can use technology and 3D and so on, and virtual reality and augmented reality. But one of the things that I find fascinating, and I think about it in retrospect now, we used to always build show suites. And full show suites, like 700 square foot show suites, 600 square foot show suites, et cetera. And we'd have them fully furnished, and you'd show every aspect of the unit. And then what happened? As the unit sizes got smaller and smaller and smaller and smaller, you're not going to build a 300 square foot show suite because it would actually show very poorly. So instead, we went to vignettes. So we're like, here's a sample of a kitchen, and here's a sample of a bathroom, and you can kind of imagine what the living room looks like, except you can't, because a regular person can't imagine what a 150 square foot living room looks like. They think of, well, I've been in a 650 square foot unit, so I sort of understand dimensions. So how different could a 400 square foot unit be? Very different, because the bedroom stays the same size, the kitchen sort of stays the same size, and the bathroom has a minimum size. So then the remaining space becomes a closet almost. And I think that's where we're going to go back to. We're going to trend back towards larger units, and we're going to trend towards going back to showing people a full unit and what they're truly buying.
That is what we're seeing as well. And obviously, when the market's hot and everything's selling within 2 weeks,
correct,
developers that need to spend $1 million to build a
correct
showroom. But going back to, I think I like the way you put it before in regards to like the infrastructure and the housing for the population. Just overflowing at the seams.
Yes.
Moving forward, like how do you see, like especially younger generations, like trying to get into the housing market? Like what's their methods of getting in?
Sure.
Especially with like wages not catching up.
Yeah. So I think there's a few things. So one of the challenges with the reason that Toronto has tremendous infrastructure challenges is that, again, through both, it's both the industry and, the administration, as vis-a-vis the Toronto planning department and so on, where we ended up over concentrating population in certain areas and completely underserving other areas. And if you look at, cities that we all love, so you look at cities like London and like Paris and so on, you look around and you think there's no towers. Yet those cities are more dense, because they're like the amount of population per square kilometer is higher in Paris and London, but everything's 6, 8, 10 stories. So how do they accomplish this? Well, they accomplish it because everything is there are no houses. Like in Manhattan's a great example. People think of Manhattan as these giant towers. And yes, there are areas where there's some big towers, but even those giant towers, even the 100-story buildings in Manhattan, generally it's 1 to 2 units per floor. So a 100-story building in Manhattan might be 125 units, and a 100-story building in Toronto is 1,500 units. So the concentration is crazy. But I was just in New York last week. When you spend time walking Manhattan, there are no single-family houses, but there are a ton of townhouses, and you walk through neighborhoods like the Village, Tribeca, Soho, which is where everybody wants to live. Those are the hottest neighborhoods. The Upper West Side, the Upper East Side. The buildings generally are 10 stories, 12 stories, 6 stories, 5 stories. They're not giant towers. And where they've put giant towers in Manhattan, that's generally where the investors buy. So it's usually offshore foreign investors. So all those billionaires building, they're not full of people who live in New York.
Empty.
They're empty, and they're people parking, and that's great. Like I respect the fact that if your wealth, it comes from the Middle East, Asia, Africa, South America. If I had that kind of wealth, I would buy a $10 million unit in New York and just have it sit there for a rainy day. Like, that's great. That's not Toronto. But again, getting back to the density of Manhattan is actually high, but it's achieved by filling in all the gaps. You'd have buildings that are highly livable, that are pedestrian oriented and human scale, and all those services that are already there would continue to be there and support it. So let's not pile huge density in one spot and then no density in another spot. Let's spread it out. So Bloor Street, again, same thing. Yonge and Bloor, massive density. Avenue and Bloor, little less density. Once you go west of Bathurst, no density. The whole Danforth, we have a full subway under the Danforth. I love the Danforth. The Danforth should all be 8, 10, 12-story buildings. And the beauty of building 10-story and 12-story buildings is you don't have to give space. You can actually have them all touch each other, like you see in places like one of my favorite cities to build in and to spend time in is Washington, D.C. Washington, D.C., you can't build anything, I think, over 10 stories because you can't build anything taller than the Washington Monument. But it's a 5 million person city. So it's got huge density and everybody lives, there's very little single family in Washington proper. Everybody's living in a condo, but the condos are all human scale and people love it. And some of the richest people in America live in Washington, D.C. by choice in a condo because it's such a great city, because they've managed the density. And there's not a neighborhood that has a crazy amount of people and then another neighborhood that has no people. It's sort of balanced out throughout the whole city.
I hope the planners of the city will listen to this podcast.
I hope so, but I think
point.
they're starting to respond, and I think some of the things that we're seeing at council, and as I said, some of the motions that I think were brought forward by Brad Bradford about let's at least embrace mid-rise as of right on all the major avenues. So you fill in because there's just such great neighborhoods. I love Leaside's a beautiful neighborhood, but again needs more density. I used to live when I first was in Toronto as a 20-something. I lived at Yonge and Eglinton, which used to be called Yonge and Eligible, because it was the coolest neighborhood, and we had the coolest sort of restaurants and bars and clubs, and we all lived in townhouses and row housing, and we loved it. That neighborhood doesn't exist anymore because
just condos.
We just jammed so much density and so much height. But then you move a little further, you move to Bayview. Bayview still has that neighborhood feel. Bayview doesn't feel like it's all been replaced by box stores and chains. Bayview, south of Eglinton, all the way down to St. Clair, this is a great strip. Mount Pleasant, same thing. Eglinton to St. Clair, very human scale, great businesses, restaurants have been there for 50 years and so on. That wouldn't change if we filled it in with 8 and 10-story buildings. And that's how you're going to fix affordability. Because what happens is a single family home in that area is $2.5–3 million. So no one's buying that. No one's affording that as a new family. But if you let me build a 10-story Equiton Developments condo, and I can have prices starting at $600,000–700,000 for a proper unit that a couple with a young baby can live in a building that isn't ridiculous, that now allows for affordability, allows for upward mobility. That family will live there for 5, 6, 7 years. Their kid will grow up, they'll have another baby, they'll get better jobs, they'll continue to get raises, and then they'll move into the single family house. That's because they'll take that $700,000 or $800,000 condo, sell it for 1.2. They'll have better jobs. They'll buy a $2.5 million house a block away. The kids don't have to change schools, and the next family will move in that is 10 years younger. And that cycle, that's what we need. What I can't understand is who's moving into the 71st floor, 380 square foot studio.
What do you think that's going to happen to those type of units?
I think the owners of those units will continue to look for short-term tenancies. I think in many cases you might actually embrace short-term tenancies, and I'm not talking about like weekend Airbnbs. I think that we've seen that happen in buildings in Toronto, and they become what they refer to as ghost hotels, and those buildings can get in pretty rough shape pretty fast. But I do think what can happen, what I mean by short-term is, and you see this again in places like New York and London and Paris, executive rentals. Like if I need to be in Toronto for 3 months for work, maybe I'm an American or something else coming to work at the university, giving lectures or so on. If I could get a 300 or 400 square foot fully furnished bachelor unit that is on top of a subway, that is because I'm not living here. I still live somewhere else. My family's still somewhere else. I just need it temporarily because I need to come here and earn some money. I think I think Toronto's a big enough city. There will always be demand for that. So I think condo corps need to think about, okay, should we allow, monthly tenancies? Because monthly furnished tenancies is not, you're going to get doctors, you're going to get lawyers, you're going to get business people, you're going to get people from the film industry. So there will be other alternative uses for those type of units.
Hopefully it'll attract more people from the global scale.
I think so, and I think that's the other thing where again I don't agree. I have strong disagreements with our federal government, and if there's a change, maybe that they'll reconsider this. Banning foreign investment into Canadian real estate has no effect on Canadian real estate, and if anything, it has a negative effect. And and it's the simplest way to look at it is why is the governor of Florida not banning Canadian ownership? Like, why doesn't he say, you know what, prices are pretty high in Miami, I should just kick all the Canadians, the hundreds of thousands of Canadians who own real estate in Florida, let's just deport them all, take back their real estate, and see what happens to prices. So here's what would happen. There'd be a tiny little bit of price decrease because you'd flood the market with all these available units, but the entire Florida economy would collapse. And people would be living in neighborhoods that were once vibrant, saying, where'd all the restaurants go? Where'd everything go? And it's like, well, because you kicked out millions of Canadians who were spending tens of millions of dollars a year on all this stuff. Now it's gone. So that's the interesting thing. That's why, like New York, there's no ban in New York on billionaires from around the world owning property in New York. They love it. They like foreign investment. If you kicked out investors out of London or out of Paris, it would change the whole dynamic of the city. I remember looking at a stat. Now it's getting a little old, but I know it hasn't changed because they put a ban on foreign ownership. But I remember I was meeting with government folks about 5-7 years ago on this very topic, and they were very strong on we've got a real issue because foreign ownership in the GTA was traditionally at about, I think it was like 0.5%, like 50-60 basis points. And they're like, in the last 5 years, it's gone into 1.25%. Like it's 2.5 times. It's like we have a crisis. And I was like, okay, what do you mean we have a crisis? That just means Toronto's finally getting on the map and finally being seen. It's an international city,
which is a good thing.
That should have international investment. And they said, no, but like we don't like it when things move too quickly and like doubling and tripling and so on and so forth. And I said, okay, but in my humble opinion, you're looking at the wrong statistic. What you should be looking at is what is the amount of foreign ownership in LA, in New York, in Miami, in London, in Paris, in Hong Kong, and see where those levels are. And what's interesting is like a area like Manhattan, if I remember right, the amount of foreign ownership was like sitting at like 15-16%, and we're at like 1.25. So I'm like, and London was similar. And it's like, guys, we have nothing to worry about. Like maybe a healthy city is one where we'd be at 5, 6, 7, 8% foreign investment. And again, you can tax it, you can police it. Like don't make it so that it's illegal, but instead say, listen, if you're not a Canadian resident or a Canadian citizen, then there's a offshore residence tax that you have to pay one time on your purchase price, but make it reasonable. Don't make it ridiculous. 3, 4, 5%. And many countries do that. Most of the Caribbean countries do that. You want to buy property in Bermuda and you're not a citizen of Bermuda, I think it's a 10% tax, but they still sell lots of real estate because it's a great island. And why wouldn't you want to be in Bermuda? And if I have to pay a tax because I'm a foreigner, I can live with that. As long as it's not an endless tax. So I don't think it should be a tax that's annual. I think it's just a one-time on the purchase price. And again, if you make it 30%, then it's ridiculous. You might as well make it illegal. But make it something that's reasonable, somewhere between 3 and 5%. If you're worried about it. If you're not worried about it, don't have the tax. And yes, we had a speculation issue in Toronto. That was not anything to do with foreign investors. The Toronto speculators were all locals.
Mom and pops?
100%, yes.
The solution to the housing affordability-wise, I think you put it pretty well, was to create more low-rise, mid-rise townhouses. Is that the type of product that Equiton's going to be focusing on?
Yes, yeah, because we want to, because we are an investment company, and because our goal is to always provide our investors and our partners with the best returns possible. We look at building housing the same way. We want our homeowners, whether they be, as I said, value-based investors or actual end users, we want them to get the best value possible. And value is, you always generate value in 3 ways. You generate value by building high quality, amenity-rich buildings. You generate it by being in neighborhoods that are existing, sought-after neighborhoods that already have the appropriate infrastructure to support the density and to support the lifestyle of your residents. And number 3, boutique is boutique. And it's interesting. Like, why are certain Rolexes worth so much? Why are certain Pateks worth so much? Because they're rare, and real estate is no different. So, when you build buildings with 500 to 1,000 units, there is no sense of rareness and there's no sense of urgency. And when you build them in neighborhoods where there's 10 other buildings right next door that are the exact same size and scale, then how do you differentiate yourself? Whereas if you go into, places like neighborhoods, like we were saying, like Bayview, south of Eglinton, Leaside, and you build a boutique building with 100 to 150 units, 200 units, that's a rarity. That's a rare commodity. And then especially if you build units that are very livable. Like, we have some great sites in the beaches area, and I love that area. And again, not towers. There shouldn't be towers there, but they're absolutely 12, 13, 11-story buildings. It's fantastic. And that'll actually make it affordable. People think the beaches is expensive. It's only expensive because there's not enough density. So the trick is to get the density just right. You don't want too much, but if you have too little, it's unaffordable. And if you have too much, it becomes a commodity. So you have to have just the right amount.
Where people want to live in it, and for the long term, so there's less turnover as well.
And if there's less turnover, whether it's owners or tenants, the investor does better, because investors do better when their tenants are there to stay and grow within the building.
So what are some of the projects you guys will be launching soon? I know you guys now have cool condos in Etobicoke.
Yeah, so we soft launched cool condos in Etobicoke, and again, Etobicoke is an example on the Queensway of a very established neighborhood where people want to be. That's very amenity rich. It's a small building, so 11 stories, and again, less than 200 units. And we soft launched it. We're actually going to do a major launch of it this coming January. So we're making some adjustments to it and to basically make sure that people understand the value proposition of the building. And I've made some adjustments to some of the units. We really want to focus on livability and make sure the units, are size appropriate. So that one's coming. Then we have a project on Kingston Road, which is Upper Beaches. That will be launching in April. Again, I was just before this podcast was in meetings making adjustments to the amenities and to the units. We're again making the units a little larger and really making sure that we hit the target market that we want. Beyond that, we have another site on Broadview, so very close to the Danforth. That could launch as early as this coming fall. So that'd be 3 projects in market. And then we have 4 other sites that we're working on design and engineering with. So in a perfect world, we would like to be launching 2 to 3 projects every year is our goal. So
that seems pretty ambitious. Would you say Equiton's in a position where they can still weather the slower market?
Absolutely, yes. Yeah, one of the great things about Equiton is we buy all of our sites with cash. So we don't carry any debt.
Loans.
Yeah, so we have no bank financing. So that allows us to have that ability.